Hey everyone, my name is Jack, and boy, what a strange stock market we find ourselves in. Really strange times in general. But before I get into that, just to bring you guys up to speed as to what this series is, for those of you who might not be familiar, this is a series where I'm trying to build a $100,000 portfolio in this platform, M1 Finance. Now, there are plenty of other M1 Finance YouTubers, and they actually were a inspiration for this portfolio. You can see right here I have the Joseph Carlson Dividend Fund, which is a major portion of my portfolio. And I have made some adjustments to his portfolio, but you can do that very easily with this platform. You can copy other people's portfolios, or M1 Finance calls them pies, and you can add that pie to your own portfolio and make adjustments to it as you see fit. And you can definitely do that with mine as well. I always include a link to my current fund, my current M1 Finance portfolio, based on the episode in the description of each episode. So if you like what you see, or if you want to take an element of my pie, you can go ahead and do that, and you can make adjustments to it as you see fit. It's one of the great things about this platform, and that's not the only great thing. The best thing about M1 Finance is the fact that it is free. So you can get started with very little money as well, since it allows for fractional share investing right off the bat. So you can get started with very little money and actually invest into some otherwise expensive companies. And another great feature that makes investing with M1 Finance really easy, which is the big reason I like it, is that it automatically rebalances your stock holdings based on your target allocation. So as I add cash to this portfolio, it will distribute itself among my underweighted sections of my portfolio, and as I earn dividends as well, it'll do the same thing. So that's really handy. It makes it very hands-off compared to a lot of other brokerages. Obviously, if you want more hands-on option, there are others, but M1 Finance, I think, is really tailored for the longer-term investor who wants to keep his allocations balanced and also to really enjoy a very nice interface that's tailor-made for building well-balanced portfolios. Now, to the stock market. What on earth has happened this past month? A lot has happened, and just kind of to recap where I'm at, I'm up on my portfolio, which I think I have no business being up in, or at least fundamentally, it doesn't make any sense. Yes, I have some good companies in here that are probably doing better than most of the rest of the market. You can always cherry pick good companies, but it's hard to actually pick those beforehand. So let's just take a look at this section of my portfolio, the Ben Felix balance, which is mostly just broad index funds of the U.S. stock market. So I started this portfolio back in January, late January, where the market was at basically all-time highs. So there was no signs that the market was going to plummet as it did, since the pandemic was relatively isolated, we'll say, and didn't seem like it was going to be as catastrophic as it ended up being on the economy. So we obviously know what happened at the end of February and into March. The market tanked completely, and even into April as well, before it started this weird recovery we've seen. But fundamentally, the economy is in a much worse place. We have companies declaring bankruptcy left and right, retailers not paying rent. Hertz is a great example, large rental car company that I covered on this channel. I've covered a lot of these issues on my channel with what's going on with the economy and the dangers we have right now, and as people try to get back up on their feet, how much harder it is because of what's happened with this pandemic. And I think it's very safe to say we're in a fundamentally much worse position than we were when I started this portfolio, yet I am actually up significantly. The market's down today, this morning, as I'm filming this, but I was up almost 20% on the money-weighted return on M1 Finance here, so just a couple days ago, and that just didn't make any sense. Well, it does make sense, but not fundamental sense. It makes sense when you consider other factors, which are the two things that I think are driving this market up, and I think it's very dangerous. One of them is the one that everyone is familiar with, and that's the Federal Reserve printing lots of money. Basically, it's debasing the currency to inflate asset prices. It's not as though the Fed is creating any new value. I've covered this before on my channel. I'm very concerned with what they're doing. I know why they're doing it, but I don't think it's a good idea, especially at these kinds of levels that they're getting into, printing trillions of dollars to buy the municipal debt of the United States. And now it's starting to buy corporate debt, which it's not supposed to do, but that's beside the point. But basically, confidence in the Fed and the Fed's actual actions themselves are driving asset prices up, as they are trying to do. But they're not creating a better company than before. All they're doing is debasing the currency, taking that inflation basically and adding it to the market. The people see that the Fed is being super active. They've been very explicit about it. They're expecting it to stay super active. Debt is still super cheap, so companies are taking out lots of debt. People are taking out lots of debt to keep this bubble going in a way. Maybe it's not quite bubble level, but it's definitely inflated over what it fundamentally probably should be, at least in my view. Of course, I could always be wrong. But the other thing is speculation. That's driven more individual stocks up, maybe less so than the entire market. It's hard to say. But we just saw recently with Hertz. Hertz is a bankrupt company with stocks that really should be worthless. And they were practically worthless. They got down to 50 cents a share right after they made their bankruptcy announcement. And the reason the stock price probably should be worthless is because once Hertz gets through bankruptcy, they have so much debt that there's not nearly enough equity to cover that debt. So what happens in bankruptcy is shareholders get wiped out in that situation, and bondholders essentially become the new shareholders of the reorganized company. Shareholders get wiped out. That's the risk you take when you take stocks. I did a video on this just a few days ago. But the speculators see this as an opportunity. You see a lot of people on Robinhood, for example, with another free stock trading platform. By the way, if you don't have a Robinhood platform, I have a link to get a free stock by opening up your Robinhood account in the description below. Please go ahead and do that, and you can close your Robinhood account right after that if you don't care about them, but at least get your free stock in the meantime. But you have a lot of newbie Robinhood investors, or maybe not newbie Robinhood investors, who are going in, see that Hertz is rising in price even though the company itself is basically worthless, and are buying it because they're speculating that the price will just keep going up even though the stock fundamentally has practically no value. So you're seeing that. Another great example is the FANG stock. Not FANG as in Facebook, Amazon, Netflix, Google, the big tech stocks, which I have a lot in this New World Order section of my fund, which has a lot of tech stocks in there, including Amazon, Google, and Facebook. So those stocks have really propped up a lot of the value because they're kind of seen as the new safe haven. But there's so much basically blind investing going on that this Chinese real estate holding company that happened to be named FANG went over many times over in value because people thought they were buying FANG stocks. They thought they were buying tech stocks, when in fact they're buying some random Chinese real estate holding company that happened to be named FANG. So you have a lot of just kind of insane investing going on where people are investing into the stock market thinking stocks only go up. They can only go up, which obviously is not the case. Stocks can go down. We've seen it. Companies go bankrupt. These things happen. But I rest my case there. I'm more concerned with Fed printing. Speculators get wiped out at some point if they are too reckless and things correct themselves. But what could wipe out a lot of people, I think, is reckless money printing, which we're really more than towing the line with that right now with the Fed. I don't like what it's doing. Economically, it just doesn't make a lot of sense. Politically, it makes sense, but economically, it is not good fundamentals, if you ask me. Other people disagree, mainly those who would support modern monetary theory, where you just print your way out of everything. But I've seen enough hyperinflation cases through history that make me think that is a very bad idea. But I can't control the Fed. The Fed is its own thing, and they control the money supply. I don't. So what am I going to do about it? That's where the big change to my portfolio has been made. For those of you who are familiar with the series and have been following along, maybe you noticed this right away, but I've added a new gold and silver slice to my M1 Finance portfolio. It's 5% is the target. It's not quite there yet. I've been adding a little bit of money. And I also sold off the bonds section of my Joseph Carlson dividend fund to raise some cash for that. So that's the big change in my portfolio. I never would have thought I would have started buying metals given what's going on. And let me explain why I did this. So in here we have mostly gold mining stocks, but also gold and silver ETFs that actually track the value of the physical metal itself. So that they're not producing anything necessarily, it's just following the commodity price, which has been going up in recent months because of all this money printing. And also people are fearful. This section of my portfolio is not a hedge to the stock market. Gold historically hasn't really served as a great hedge to the stock market. People do go there when the stock market goes down, mostly out of fear, because gold first and foremost, is a store of value. Really, any currency is technically a store of value. It's just the difference with gold and other precious metals is you can't print trillions of dollars of it. Yes, it's not technically finite since we're mining more of it all the time, but much smaller amounts than the amount of trillions that are being printed when it comes to quantitative easing with fiat currency or paper currency. So that's where gold has its value. It's scarcity. It's always been considered a store of value, just like any other currency. The only difference is it can't be printed. And because it's a good store of value historically, I think it'd be a decent idea, rather than using bonds right now, given the rapid inflation that we're going to be seeing and the practically negative yields we have on some bonds, I think it's a decent idea to move some money into gold and gold stocks to try and protect myself at least a little bit against all of this debasing of the currency. Because as inflation rises, I would expect gold prices and really stock prices to rise as well. But I think stocks are very overvalued right now, so I'd rather start getting into some metals to at least diversify my holdings a little bit. And ideally, if gold rises enough, we'll have these mining companies, which make up a large portion of the slice, the majority actually. The mining companies will see a lot of profits, and hopefully their share price will also rise a lot, and maybe they'll start paying out some heftier dividends. We'll see. But that's what makes up this section of my pie. Again, I never thought I really would have considered doing this, but I never would have thought that the Fed would be this crazy when it comes to printing. Maybe because I just wasn't paying attention, but that's kind of where we're at with that now. And I'd love to get your guys' thoughts on that, on buying gold and silver or just commodities, I suppose, different stores of value besides stocks, given this current economic and monetary system that we're in right now and what's going on with policy. I think it's a good idea. Obviously, you might disagree, and I'd love to hear why, because there are a lot of different ideas as to what to do when the Fed is printing. I'm not going to try and beat the Fed by selling off and trying to time the market, because that's very difficult to do, if possible at all. You never know what direction the market's going to go, as I've said many times before on this channel. So I'm not going to try to do that. Instead, I'm going to keep adding money to this portfolio, but I really don't want to be buying a lot of stocks right now. I just don't like where valuations are at. I'll cherry pick some stocks here and there that I think might be a little undervalued compared to where they were, or if the market dips enough. It's dipping today, not a ton, but it is dipping today, and if it keeps going down to where it probably should go down to, then maybe I'll buy some more, but then again, so would the Fed. So I'm going to add this. I'm going to keep adding money to this gold and silver slice, at least until it reaches 5%, which will be done shortly. I'm adding some money to the portfolio today, and we'll see what happens there. And if I don't like where the direction's going, I will keep increasing the allocation for this gold and silver stock portfolio to try and hedge myself against all of this inflation and all of this euphoria in the current stock market. So that's all I've got for today. If you like this video, please like it since it helps the channel out a lot. Again, I'd love to get your thoughts about how you are potentially diversifying your portfolio, not diversifying your portfolio during this volatile and strange time. I'd love to hear your strategy and what you think works best for you and kind of what you've been doing through it. Maybe you haven't changed your strategy at all. That's certainly a viable strategy, is to not change your strategy as well. Maybe I'm completely wrong here. We'll be able to tell many months from now, maybe quicker. We'll see. So be sure to subscribe so you don't miss any of my new updates, since I post a new one of these episodes every single month on the 15th, and you can see what has changed, whether my portfolio is going up or down. If I've made any changes to allocations, I will always go over those every single month. But until next time, take care.